Right, good morning, good afternoon, and good evening to everyone. Welcome back to this month's episode of the Trading Vault with VT Markets. If I could please just do a quick audio visual check and make sure that you can see me, see my screen, and also hear me loud and clear. If you could just post in the chat box. As always, please introduce yourself as well. Let me know where you're coming in from, how long you've been trading, what your problems are, what issues you're facing with your trading at the moment, what you're trying to get from these webinars, all those sorts of things would be great information for us to really tailor these webinars going forward to make sure that we're providing the best information, the most relevant information that you guys need as well. So uh, you should be able to see on the screen a QR code which you can scan, which would take you to the opportunity to register an account with VT Markets as well. As always, we would like you to stay on at the end of the call as well, just to answer a quick short survey, just which will help us make sure that we're providing the best content and the best stuff and education for you guys. So. Without further ado, let's jump into the session. Um, this month's session is going to be on managing risk in uncertain environments. I don't think it's any secret we are in a very volatile period in globally at the moment, not just for the financial markets, but geopolitically and just in general. With everything going on in the Middle East, we've still got the Ukraine-Russia war going on as well. There's just and also the tariffs and all of that sort of stuff is still ongoing. So we're living in a very, very volatile time, a very, very uncertain time. Markets do not like uncertainty. We're very much seeing headline-driven moves, unpredictability in terms of communications. And pretty much every weekend we're finding some sort of gap up or gap down in the markets, depending on what asset and instrument you're going to be trading. So, it's really, really vitally important that we know how to manage our risk in these situations, because if we don't know how to manage our risk, that's when we can do some serious damage to our capital, lose a lot of money, and potentially even blow up our accounts and cease to be traders. So it's vitally important that we understand the markets and how to adjust our risk and how to adjust our position sizing when we are going through such uncertain times. So there's a few slides to cover, and then we will jump into the charts. I want to show you an example of something that happened to me a few weeks ago now as well. I think which will illustrate this really well. In how to manage risk and the consequences of if you do not manage your risk properly. But as always, please, as we're going through the presentation, please do ask your questions in the chat box. I will answer any questions that come up that are relevant there and then, but we will also do a Q&A at the end. If I do miss any, then I do apologize. It won't be intentional. Please do just feel free to post a question again if I oversee it. Okay, so let's jump into the presentation. Got some people here from Sweden, London, just around the corner from me, Mohammed, Kenya, Malaysia. Great, so a real good mix from around the world. So let's jump into the presentation and then we'll get into some charts as well. Right, so just a quick introduction to myself. Most of you, if you've already been on these webinars, will know who I am. I am Ross Maxwell. I am VT Markets Global Operations Strategy Lead. It is my responsibility to provide high-level education content for traders of all levels. That's whether you're a brand new beginner or even experienced trader. I will provide education, hopefully, that will improve your trading as well. I am a professional trader and I'm also an investment manager, and I've been trading for more than 20 years now. It's actually 25 years this year that I've been in the markets, with a career that started in London all the way back in 2001 and took me to Hong Kong, and now as an independent trader for the last 12 years or so. I'm also an award-winning trading coach and mentor and a founder of Keyzone Traders, which is an online trading education company. Okay, so as I say, today's focus is going to be very much on managing risk in uncertain environments and how we should position ourselves and how we need to adapt in the markets. Okay, so as spoken about in the introduction, right, we are currently living in a period of extreme uncertainty from a geopolitical point of view. Now, the markets, they do not like uncertainty. and it can create high two-way volatility in the market. So we can see spikes up, we can see spikes down, depending on the rhetoric. We're seeing this even just in the last week. Last week Donald Trump comes out and he says, ceasefire, we're close to doing a deal. Even last night, there was 1 hour Donald Trump said, or even like, so you had they're never going to close the strait again. 24 hours later, Iran closed the Strait of Hormuz again. Last night, Donald Trump says, they're sending a peace delegation to Pakistan for a second round of talks. Iran come out and deny it. This constant rhetoric and change in terms of what's going on creates uncertainty in the market, and it can create two-way volatility. So it's difficult to establish a long-term trend, because one tweet, one comment, one bit of information, one action can change, and then something else can happen in the opposite way, even just a matter of hours later, and it completely spikes the other way. So it's very, very difficult to create consistency in the market and have like a true opinion and bias in terms of which way the direction of the market is going. So we need to navigate this volatility with discipline and clarity rather than emotion. If we make emotional decisions, we will lose money. So we need to trade with discipline and clarity in terms of what our objectives are, and how, and most importantly, how we will manage our risk. And this is because protecting capital and disciplined risk management is vital, not just to keep your capital safe, but also to take advantage of the opportunities this environment also gives us. So higher volatility creates higher opportunities, right? It does create good opportunities, but only if we know how to manage our risk, manage our trades, and approach the markets in the right way. If you don't know how to do that, then you're gambling and you're going to lose money. So one, you have to be able to preserve your capital and protect yourself from these volatility swings to make sure that you don't lose too much money. But equally, by doing that, you are going to give yourself more opportunities to be able to take advantage of the chances and the opportunities that will present itself in this type of market environment. So let's have a look about what creates market conditions. Okay, so the markets are driven by news events, which therefore creates liquidity and also shift sentiment. So at the moment, we are very much driven by headlines in the news. Okay, some, like the majority of the time, historically, you will be driven by sentiment in the market, and that creates the liquidity, and therefore that creates price movement. But actually, at the moment, we are being driven by news events and geopolitical events around the world, and very much being driven by headline news. So, it's a tweet, it's an action, it's something, an event that takes place rather than just general sentiment. That event will then shift sentiment, and then it will also create liquidity in the market because people are reacting to that event, and therefore the market price will move. Okay. Now, some of these news events are predictable, such as economic releases. Okay, so we are waiting to see the impact that this is all going to have on global inflation, on interest rate policy, and all of those sorts of things. Okay, and retail sales and that. But those data points are predictable. Those economic releases, those economic data releases are predictable. They're scheduled in. We can check them within the VT markets calendar, the release economic calendar, and we can prepare for them. Okay, so we can prepare our positions around. We can manage our positions. We can prepare our trading around those because they are scheduled in and they are predictable. However, in the current environment, an increasing number of these events are becoming unpredictable due to the current geopolitical climate. There is no way of knowing when Donald Trump is going to send out a social media post on his Truth Social platform. There is no predicting what he is going to say on Air Force One when he's traveling to and from certain places. There is no way of predicting, what Iran are going to do, how they're going to react, when the US are going to hijack an Iranian flagged tanker. There's no way, all of these sorts of things are highly unpredictable. Absolutely no way of predicting when they are going to happen. Okay, so because of that, we need to expect increased volatility and unpredictability and prepare for that. Okay, so we need to prepare for the unpredictable. Okay, I know that sounds a bit of an oxymoron, but you can prepare yourself by managing your risk and the risk that you're opening yourself up to, rather than the event and the action and the price movement itself. Okay, so please do expect more liquidity grabs and false breaks. We have covered these in previous sessions, which you can get recordings for as well. So you will be getting more of these sorts of market movements, like which create these liquidity grabs and false breaks in this environment. Do not look for aggressive profits. Okay, so you need to be risk focused rather than profit focused. Don't keep thinking, well, the market's moving 200 points, therefore I can make loads of money. You've got to understand that if the market can move 200 points in your favor, it can also move 400 points against you. Okay, so it's about protecting our downside, it's about protecting our risk, and therefore the profits will take care of themselves. Okay. Um, Yeah, thank you very much, guys. So you can see that the guys have posted in the economic calendar into the chat box. I highly recommend, especially in the current environment. I do this each week. I make a note each week in my diary of all the high impact news events that are coming out that are scheduled in. I put them into my calendar to give me alerts for when they're coming, and I re-double check every single morning to see what's coming out and what's happening that day. So I'm completely aware, completely up to date with exactly when these are coming out. Don't just see the market move and then go to calendar and go, oh, the market moved because of this news release. Okay, the economic calendar there with VT markets, you can click on it. You can please do prepare yourself properly for knowing when these events are happening. Okay, there's no excuse not to know way in advance of when these economic releases are happening. Okay, so when to trade, okay? So you need to be selective and only trade the highest quality setups. That is generally true anyway, but you almost need to be even more selective in the current environment. You need to be disciplined and follow a clear and decisive trade plan. Again, we've spoken about trade plans in previous sessions and how important it is to give you the structure and the framework to be able to approach the markets. And again, this it's always vital. You should always do it. But it becomes even more vital in the current environment in terms of how to approach the uncertainty. If you don't have a trade plan, then you're uncertainly following an uncertain market. At least with a trade plan, you have a certain structure to follow an uncertain market. Okay. So you only want to trade when you have a clearly defined structure, whether that be a clearly defined trend or clearly defined range. Okay. Do not change don't trade just for the sake of it. Don't trade choppy markets. Look for clean entries with defined risk parameters. One other thing that I would also probably suggest, and this is to trade active market sessions, which can create more stable liquidity. Okay, so by that I mean trade the US session, US equities, London session, European session for like European equities, Asian session for Asian equities. Stick to those sessions if you're trading equities specifically, because it creates more stable liquidity around them. Forex is a little bit better because you've got like the market is open, sorry, for pretty much 24 hours a day, 5 days a week. Avoid trading maybe over rollovers when spreads can widen over the rollover, which is at 10 o'clock in the UK every evening. There's a period when commodities are shut, so avoid trading those sort of areas as well because liquidity can become unstable. So stick to the session, stick to where the main liquidity is, because that will really just smooth out any sort of volatility spikes as well a little bit. One other thing that you could do, you could wait for confirmation signals. So rather than just entering the market, I personally generally use limit orders, which means if the market moves into an area, it will just execute me. You could, in this period, wait for confirmation signals so that you're not in the market until there is a clear signal for you to enter, which could just reduce the exposure to some of these like extreme volatility spikes. And again, the example that I'm going to show you in a bit about what happened to me a few weeks ago will demonstrate this too. And by confirmation signals, that could be, wait for the break, wait for the retest of it rather than trying to trade the break itself. Wait for strong candle closes, because again, if you can see this volatility spike and then the headline driven spike often can be traced to create that liquidity grab. to create that false break scenario. So try and get those strong closes to avoid getting caught by these liquidity grabs and false breaks, or look for reversal or continuations or candlestick patterns. There's a multitude of candlestick patterns out there. Maybe wait for some form of reversal or continuation pattern to confirm the movement in the market before jumping in. Okay. As I say, guys, please do post any questions that you have in the chat. Just a couple more slides to go through before we will start jumping into the charts as well. Okay, so it's important to know when to trade, but actually it's probably more important to know when not to trade in the current environment. Okay, so avoid low probability setups. Do not trade just for the sake of trading. If you have to question whether the setup uh, qualifies your criteria from your trade plan, then you probably shouldn't be trading it, because it should be obvious, it should be clear, it should be very clear in terms of it makes up part of your trade plan. So avoid low probability setups. Avoid trading during high impact news releases. Again, check that VT Markets calendar, which the link has been posted into the chat box, when we can see more unpredictable volatility spikes. Again, unfortunately, we cannot prepare ourselves and avoid trading around a Donald Trump social post. Unfortunately, Truth Social post, that's outside our control. But what is inside our control is to identify when these economic releases are, know which ones are likely to create volatility spikes, and therefore either avoid trading during them, or make sure that our trade risk is managed around them. Okay, so that could be, reducing exposure, scaling out, anything just to reduce the risk and the impact in the market. Avoid trading choppy markets with no defined structure. Again, that really goes back to avoiding low probability setups. Avoid trading unexpected volatility spikes and wait for the market to present itself. And again, so what happens here, and then this is again what leads to emotional trading. Okay, we can see some really unpredictable volatility spike. Again, when it happens, we may not even know what has caused that volatility spike. It's going to be a news-driven headline, most likely something from Donald Trump, most likely something from Iran, likely something that is impacting that process at the moment. But in that moment, we see the volatility spike, and a lot of people see the move, see a quick move, and their emotions are like, "I need to get in on that move." It's like that FOMO, that greed, the fear of missing out on a potential move in the market, trying to catch every single move in the market, and they emotionally jump into a trade. Okay, now what is more important is to don't trade that volatility spike. Take a step back, find out what has caused the volatility spike. Let the market present itself. Let the market determine whether it's going to follow through and create a trend, and therefore, get in on the pullback, get back in on the retest or some sort of form of continuation pattern, or it's going to retrace, and it's going to be a lot of headline news driven moves can retrace as well and create that false break. If you give it time and it presents itself as a false break, then you can start to make your next trading decision. So don't emotionally jump in on a random volatility spike. Educate yourself, find out what has happened first. Let the market follow the price action. Let the market confirm how it's going to digest that information going forward, and then exercise the patience to wait for the setup to get into the market. Okay. There is likely to be more inconsistent price action with more stop hunts that can create more false breaks. And again, so waiting and being patient for that is really important. And protecting capital is better than forcing trades. There's a couple of sayings that I like. One is sometimes the best trade is no trade at all. Okay, so if you do not trade, your P&L is flat. Okay, you don't make any money, you don't lose any money. If you start taking real low probability trades, you are going to lose 1%, 2%, 3%, 5% of your account, and all of a sudden you're down, you're losing money. Having zero P&L is better than having minus 5% P&L. Okay, so sometimes the best trade is no trade at all. Um, And there's another saying that I really like, and if you've been a trader for, if you're an experienced trader, or even if you've just been trading for several months, like a few months, you probably have experienced this. I've experienced it in my time, certainly when I was started out as my career as an independent trader. When you're in a trade that you know you shouldn't be in, okay, that feeling is not very nice. Okay, when you're losing money, you're down. That feeling is horrible. Okay, especially when you know you shouldn't be in that trade. And actually, whilst it's uncomfortable and it doesn't feel good to miss out on a trade that actually goes and hits your profit target or goes to make you money, which one of those feelings is better? The feeling of being uncomfortable and having missed out on a trading opportunity, or being in a trade knowing that you shouldn't actually losing money, knowing you shouldn't be in it. I can tell you now that whilst it's uncomfortable, the feeling of frustration is better than that feeling of like the gut wrenching where you know you shouldn't be in a trade and you're actually physically losing money. Okay. So protect the capital. Protecting capital and being overly cautious is better than trying to force a trade and being emotional in your decision making in the current market environment. Okay, so let's talk about position sizing and drawdowns, and then we can get back into those charts. Okay, we can look into reduce our position sizing in volatile markets, as we can also expect to see more slippage in execution. We can see bigger swings in volatile spot. Bigger swings in volatility, which create more slippage in execution. We want to manage trades more aggressively by booking profits to avoid larger losses. You want to set daily, weekly maximum drawdown limits. And when these drawdown limits are hit, you want to step away, assess your trading performance before you go back in. You want to make sure that your trading performance is still right and it's not that you're acting emotionally on it before you start jumping in and start trading again. So whatever those limits are, it might be 2 or 3% on a daily limit. It might be 5% on a weekly limit. If you hit that limit on a drawdown, step away from the screen, assess your trading performance, assess the markets, work out what's going on before stepping back in, okay? Because the worst thing you can do is compound your losses. And this is when it can start becoming like emotional decisions start creeping in and you end up losing a lot of money, especially in these markets that can snowball, that can compound and can really create damage very quickly. Avoid revenge trading after losses. If you feel emotional, take a break. Create it as part of your routine to step away from the desk, step away from the screens every time a trade closes, okay? To stop you, again, jumping into trades emotionally. As again, going to repeat this again, capital preservation is the number one priority at all times. So you always need to trade with a stop in place. Okay. If you do not have a stop in place, you open up yourself to unlimited risk and you can blow an account and you can actually end up owing more money than you've got deposited in that account. Okay. So there's a huge amount of risk in trading anyway. If you trade without a stop, first of all, I would question what you have based your risk calculation on and how you're going to calculate your overall risk. And second of all, you're opening yourself up to unlimited downside, which is just insane in my opinion. Okay, this is not long-term investing or anything like that. When you approach risk slightly differently, this is talking about short-term trading or swing trading, where you need to protect your capital at all times. Widen your stop placements to allow for wider volatility and stop hunting, and that can also protect slightly against sudden news releases and unexpected news spikes. I advise using the average true range to get an idea of the current market volatility, and this allows you to adjust your risk and your stop the stop sizes and stuff accordingly. Trade in smaller size and take fewer, more selective trades as well, just to make sure that you're only taking the highest probability setups. Now, the psychology of this, emotional discipline is vital for navigating uncertain markets. If the markets are uncertain, we need to control what we can, and we need to have emotional discipline. Put techniques in place to stop emotions hijacking your decision making. Things such as mindfulness, walking away from the screen, as I mentioned, after each trade, or breathing techniques. Again, these sorts of things we have covered in previous sessions. You want to stick to your trade plan with discipline. Have a really clear, structured, written out trade plan, have it printed out, go over it every single day before each session, and make sure that you are sticking to that plan. You want to stay patient, accept losses, and avoid impulsive decision making, and be aware of what economic releases you can predict. Again, go back to that VT markets calendar. Make sure you make a note of when economic releases are coming out. Make sure you set alarms so that you are fully aware of when the things you can control, you're aware of. Manage trades as much as you possibly can to protect against unexpected headline-driven volatility, and do not chase moves after they happen. Okay, so thank you very much, guys. That's the end of the presentation. I want to jump into the screen, into the charts now, and go through a few things. But is there any questions on any of that at the moment? Is that all clear? Are you happy with the content there so far and what that means? Perfect. Good stuff, Michael. Okay, so I'm just going to stop sharing my screen, and whilst I change over to my charts. As I say, please do, if there are any other questions, please do just fire them in. We will have some time at the end for a bit of a Q&A as well. Let me just re-share my screen. Okay. If I could please just ask you to reconfirm that you can see my screen. Okay, you should see a DAX, or a German 40 cash screen with price action and a blue line going across it. Okay, good stuff. So I want to go through this. This is an experience that happened to me back on what was it, the 23rd of March. Okay, so you just under a month ago. Okay, so if you've been part of these webinars and these sessions before, you'll know how I look at the markets, and you know that I look for liquidity areas, you know that I look for support and resistance, and you know that I place limit orders in my on my trades. Okay, now this on the and we are seeing these moves all the time at the moment. Okay, this wasn't just a one-off freak moment. This is something that is happening quite frequently at the moment, and I have to prepare myself for this. Okay, now we're going to go back. There was this area here that I really liked in the markets. Okay, so there was a area of liquidity. You can see here that support, really strong reaction there. Came down strong through, impulsive push through, and at this time, I don't know if I can do the replay function actually in here, but at this time. Market came down here impulsively, and around here I was like, right, okay, retests of this area, I am going to look to go short in the market. Okay, the markets were bearish at the time. It was right in the midst of the conflict. We had high oil prices. There was real concerns around global growth, inflation. There was no real end in sight. The peace negotiations hadn't started at that point. So it's like, right, okay, brilliant. Everything is there. The fundamentals point to bearish market. The price action is bearish. I've got a really strong area of liquidity, which can act as resistance. Okay, so tick, 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 tick. Clear setup, strong setup, part of my clear plan. Okay. So therefore, I have to take the trade. I have to take the trade. Okay, so I have a short position in. At the time, I looked at the volatility, and you can see here the ATR was around 185, 200 points, something like that. So my zone's about 100 points wide, and I'm going to have 150 point stop on that, generally speaking. Okay, so if my entry is there around let's call it 22700, my stop's going to be around 22850 there. Must have had this zone a little bit lower, so like something like that. Yeah, that would have probably been it there. Right, okay, and I'm gonna okay, 2-to-1 target, something like that. Okay, quite simple, quite an obvious. The parameters and how I got that are not really relevant in terms of what I'm trying to show you here. Okay, if we want to talk more about that, we can go back to the previous sessions and the recorded sessions that we've got. But that was the trade idea that I had. Okay, so I had my limit order in the market. All of a sudden, I think it was the first sort of news headline, completely unpredictable. I couldn't have predicted that it was coming out, that there was going to be some form of peace talks or potential ceasefire, or Donald Trump came out and said something that, they're talking to Iran and all of this sort of thing. And the market, as you can see, jumped. Okay. So if we really uh, zoom in here to the market, okay, it might even be better if we go down to like a 5 minute chart or something like that. Okay. Um, if we go back to, hang on, bear with me, sorry. We need to go scroll all the way back to the 23rd of, let's just go to a 15 minute, but otherwise it might take a bit too long. Right, here we go. Okay, 20, bear with me guys, sorry. Just catching up. Maybe it won't go back that far. Okay, we'll have to stick to the hour chart, sorry. Okay. Okay, so let's just zoom in. Now, I have my risk based on 150 points, okay? And the market has gapped up the close is at 22377. The open of that next candle is 22878. So it is gone from 22377. So it's jumped 500 points. Okay, 500 points without me being able to react to it. Okay. Now, I was very fortunate in the sense that the market gapped up above my entry. So it entered me into the trade, but simultaneously took me out of the trade because it was also above my stop. So it executed an exit and took me out of the trade simultaneously. And I lost about 0.1% or something like that on the slippage on execution. Okay, so it wasn't disastrous, or it wasn't anything like that. But this, I want to show you what can happen if you are not managing your risk properly. Okay. Now imagine, for example, that the market gapped up, but it did trigger you into that trade at your required level around 22,700. Okay. And then you still got another 200 points before it where it gaps up and you actually can exit the market. Now, if I had just gone for a normal standardized ATR, or standardized stop, say use this ATR here where I have like a 50 point stop or something like that, because volatility generally speaking is much lower, I could potentially lose 4% of my account just from that spike. 200 points, 200 point jump above my entry, 50 point standardized stop. I can lose 4% of my account. By adjusting my stop due to the volatility in the market, my risk becomes, from instead of 150 to 200 points, it's 1.33%, or 1.11 and a third R. Okay. So straight away, by adjusting my stops for the volatility, drastically reduces potential losses on volatility spikes from potentially 4-5%, maybe even higher loss, to 1.3%. Okay. So straight away you can see how adjusting your stop and widening your stop based on the volatility and unpredictability in the market can help reduce potential losses. And like, it could have been even worse. For example, that spike is 500 points. Okay. Say I was already in a trade and then the market spiked 500 points. Okay. Again, if I go back and I've got a standardized 50 point stop, I can lose 10% of my account without being able to react to it. If I've widened my stop to 150 points or 200 points, or 100, let's call it 150 points, as that was this example, even in that scenario, I can lose 3.3%. Okay, again, 3.3%. It's going to be a painful hit for me. It's 3 times the risk that I would normally risk on any one particular trade. But 3.3% is a very recoverable drawdown. I go through 3% drawdowns all the time. Like, it's quite a regular occurrence. So by doing that, it's not going to hit me or impact me emotionally. But if I didn't adjust that, and I lost 10% of my account in one trade and go through a 10% drawdown in one moment, psychologically and emotionally that's going to hit me, because I don't go through a 10% drawdown ever, or very rarely. So again, it's just illustrating that, it's really vitally important that we adjust our stops to make sure that we are protecting ourselves. Okay. And if you don't trade, and again, so on this one here, say I didn't have a stop in place, okay, it would have triggered me in and would have just carried on, and I would have been, at mercy of all of this move. And you can see the market ended up moving even higher, jumping up here. If you don't trade with a stop, where is your risk? It's unlimited, and it hasn't ever come back to these levels since. So by having my stop in place, again, slightly fortunate that the market gapped up above my things. I only lost 0.1%. I think it was even less than that. By having my parameters and stop in place, mitigated the risk and mitigated the exposure to risk I had in the markets. Okay, so I think that's a really good example of this, and you can see these sort of gaps happening in across the market all the time at the moment. Okay, this is just the DAX. You've got that one there. Later on, you can see there was another one gap down here. You've got another gap up here. Look at these gaps in the market. These are another one over this weekend. They are everywhere at the moment because of the uncertainty and the headline-driven news market that we're in. Okay. So, any questions on that, guys? Is that sort of relatively clear why and how it's so important at the moment to manage our risk around these sorts of trades and constantly be looking at this and adjusting for it as well? Okay, so we've got sort of 20 minutes or so. So we can go through some more examples of how to adjust our risk and stuff like that. But please do let me know if you've got any questions. Please let me know of your experiences in the market at the moment. Have you um, been hit by a big loss or something like that? Have you managed your risk well? Is there anything in specific, any specific scenarios that you're struggling with or that you've seen that you would like some help with? Um, Okay, so Bernard, a great question. Bernard says sometimes you hit stop loss, then it swings back in and would go to your target. Which how do you deal with this psychologically? Um, I think it's a process of, again, emotional discipline, like working on emotional intelligence. Okay, understanding the market is because when this happens, what generally happens is it's a hit to our ego. Okay, because it's like, well, I was right, and the market's just out to get me. You fall into this victim mindset that the market is just out to get you, and it's stop hunting, and you want to get revenge back on the market for hitting your stop when you was right, sort of thing. So it's like this sort of emotional tug of war between you and the market. And then what happens then is you start making emotional decisions. You jump into more trades, trying to get that money back and prove that you was right, and all of this sort of thing. What we need to be able to do is not let any single result of any one trade define our next or like impact our next trading decision. Okay, so it's a case of building the emotional intelligence through mindfulness, through breathing techniques, through educating yourself and understanding that trading is a game of probabilities. It's not about being right all the time. It's not about knowing when you are right. It's about just playing the data, okay, playing the process over and over again and making sure that if as long as you follow the process, you will make money. And it is just something that happens in trading. So it's trying to learn not to take it personally through, as I say, mindfulness, breathing techniques. Emotions do not stay with us forever. Okay, every single emotion that you have ever felt in the past has always turned and gone away or changed to a different emotion. Okay, so it's giving ourselves the time to be able to let that emotion that we're experiencing go away so we can make a more rational and informed trading decision. So that could be stepping away from the screen, going and getting a drink, going for a walk, walking the dog. Like I walk my dog at the end of every trading session, go away, clear my head, get away, all of that sort of thing. There's some great breathing techniques that you can do out there as well to just rationalize yourself, calm yourself back down before making another decision. Okay, so um, for that, I really have to suggest just working on that emotional control, working on that emotional intelligence by doing some of those techniques that I mentioned there. Um, Shane says, I'm unable to find a trader in India who have good skills at technicals and market movement. Can you please suggest? Well, to be honest with you, Shane, I mean that's what we're here for with these webinars. We are teaching the skills and the technicals around the market movements that you need to attack any market, not just markets in India, not just US equities, not just the DAX in this case, not just Forex. These are the technicals that you can use across all markets and all structures. So please do take a look at the previous recordings and please do come to these webinars going forward as well because you'll get great information in how to attack the markets, not just in India, but globally as well. Um, cool. Michael says, I've been getting stop lossed out a lot. I pull standard deviations from previous Asia sessions, normally strong daily and weekly levels. The volatility is killing me. Okay, so are you just trading the Asian session, Michael? Is that what you're doing? Or are you taking Asian sessions and then trading a different session? Okay, apologies if I get this. So you're just trading the Asian session. Okay, so Emilito, I'll come to you in a moment in your question on the ATR, and we'll show that within the charts as well, so that you're fully up to date on that. So in regards to previous taking standard deviations from previous Asia sessions, normally strong daily and weekly levels, volatility is killing me. If the volatility, okay, so you're taking Asian session volatility and trading it in Europe or the US. If that is the case, then you need to take the standard deviation from the session that you are trading. Okay, there's much more liquidity that goes through London session and US session in the vast majority of markets. Okay, certainly in the Forex market, the London session is the highest amount of liquidity. So you want to be taking the standard, you want to be taking the volatility from the sessions that you are trading. Okay, because otherwise you're comparing, like there's a saying in the UK, comparing apples with oranges. You're not comparing the same thing. So if you're not comparing the same thing, you won't be getting consistency in results. Okay, so you want to be taking the volatility from if you're trading European sessions, you want to be taking the volatility from the recent European sessions. If you're trading US sessions, you want to be taking the volatility from the recent US sessions. Okay, that is really important to create a consistency in the area and the time of the market that you are actually trading. Okay, if the volatility is still hurting you, okay, again, just widen those stops a little bit. Okay, add another 20, 20 for like whatever you're doing to calculate your stop at the moment. Add another 20%, add another 25%. Just widen those stops a little bit to get it. Okay, that's what I would suggest. And again, coming back to what we mentioned, maybe just reducing your risk. If you can't get to grips at the moment with the volatility and it's hurting you, reduce your risk exposure. Okay, again, going back to this example here. Okay, I'm happy still trading at 1%. Okay, 1% risk per trade because I know even in this scenario, like in that worst case scenario, what did I say? It was like 3.3% or 3.3 R or something like that I could have lost. Okay, if I'm not comfortable with that, then I need to reduce my risk further. Reduce 0.5%. All of a sudden, that 3.3R becomes 1.6%. It's not great. It's not like, very recoverable amount. So potentially reducing risk exposure if you're really struggling still as well. Okay. So yeah, hopefully that answers that question, Michael. Uh, okay. Imelito, so again, apologies if I've got the pronunciation wrong on that. Let's talk about ATR and how we can use this and the importance of trading. Now, you know, for me, I'm not a big fan of indicators as such, but this is one that allows me to adjust my trading and adjust my stops and my risk calculations based on the volatility in the market. Okay, so you can see up here in Melito, you can click on indicators. You just find the average true range. There it is on all pretty much all platforms. I can't think of a single platform that I've never been able to find it on. You click on that and it will bring up, generally speaking, this is this sort of like red line down here. You can see that red orangey line down here. You can see the ATR. Generally speaking, the ATR the standard default setting is the 14 period. Okay, you can see that it says ATR 14. That's absolutely fine. Okay, you can adjust it if you want. You're just using it as a guideline. It's not a fixed amount. But a 14 period standard setting is generally fine. And what that basically does is it tells you the average movement in price from the high to the low of the previous 14 candles. So if you're on the hour chart, it's the previous 14 hours. If you're on the 5 minute chart, it's the previous, what is it, 70 minutes. The previous 14 candles, 14 periods, the average price movement. So when we start seeing higher volatility, obviously that price movement increases, and therefore that ATR number will increase with it. So we can therefore see, if we go, like I say, if we scroll out here, we can see that in February, if we just zoom in here, in February, before the conflict between the US, Israel, and Iran started, we can see that the ATR and the DAX, the 1 hour ATR, around these sort of highs here, was around sort of 95 points, which meant, generally speaking, every hour the DAX was moving around 95 points. Okay, that's basically what it's telling you. Now, as soon as we hit March, obviously volatility spiked. That's when the conflict started. There was higher energy prices, more headlines and everything like that. We can see that since then, that generally speaking, volatility had the ATR has increased. And we can move that up, and now you can see that generally speaking, volatility is now about 190 points. So what it's telling us is that every hour, roughly speaking, the DAX is moving about 190 points. Now, sometimes it might move 300, sometimes it might only move 100, but on average, it's about 190 pips or 190 points every hour that the DAX is trading. And that just allows us to understand and see when we're seeing increased volatility in the markets, when volatility decreases again, and it allows us to adjust our stop placements at the stop sizes as we went through in that example there to be able to protect our risk. So when the volatility increases, we can increase the size of our stops to protect our capital and reduce the amount of risk that we're exposing ourselves to in the market if there is these volatility spikes. Does that answer your question, Imolito? I think we do cover this as well in deeper in other sessions in recorded sessions as well. Okay. So Shane, as I say, please do get in touch with your account manager at VT Markets. But these webinars are a great is effectively a course to be able to teach you how to learn technical analysis, how to learn price action, but not just that. Also understand why the market is moving the way it does. We cover the psychology and the mindset side of things as well, which is just as important as the technicals when trading. But please reach out to your account manager as well. I'm sure they'll be able to help you. Okay, guys. Any other questions, guys? Because we are running out of time. We've got sort of 5 or 10 minutes left. We can go to another chart if not, and we can let's look at gold. Gold is a very volatile instrument at the moment. You can see here. Again, if we look at how we can use ATR, going back before March, we can see again that ATR was very low, around sort of 32 points per uh, point movement every 30. So gold moved around $32 every hour. And you can see the spikes. You can see the spikes up to $80 an hour there. It has seemed to have settled down after that initial sort of correction when it first kicked off and gold suffered because and one interesting thing to note on this, and this is going off topic a little bit, but a lot of people didn't understand why gold fell when there was geopolitical uncertainty. Because generally speaking, geopolitical uncertainty creates a move to safe haven assets, which would mean a demand for gold. But actually, the issue for gold was that people moved towards the US dollar more. The US dollar got stronger, which made gold more expensive for foreign investors, and therefore um, demand for gold decreased for those reasons. So Farouk, I'm not too sure what you mean. I mean, this is the trading view. This is just like trading view here. So, if we're talking about VWAP, again, we're going off topic a little bit here, but the VWAP setting, it needs to be changed at the VWAP setting input section. So let's have a look at that one. Um, yeah, it looks like they've got just default settings, which is fine on the I don't have my TradingView website up, I'm afraid, at the moment. Farik, again, if you would like to message your account manager with a specific question, I'm more than happy to go over this in a little bit more detail and provide a response for you for that one. Again, just because of it's off topic a little bit as well for the webinar, but more than happy to if you can send an email into to VT Markets, I'm more than happy to answer that one for you. Okay, guys. Yeah. So going back to this, so you can see that again, using that ATR, we can widen our zones, and therefore, oh, guys, can you hear me? Okay, I just saying that my internet's dropped out. Can you hear me? Okay. Okay. Um, okay. As you can see, just a technical issue there with my. Think if you just bear with me 1 second. Just protect my account details there for a moment. Let me log back in. And we can, okay, let me share that there. Okay. Okay, great. Yeah, thank you very much, Tim. If you could provide the email address for Farik, that'd be great. Okay, cool. Yeah, so again, we can use this ATR to determine the width of our zones, and therefore we can use that for stop placements and entries and stuff like that as well, just to protect. So, guys, I just check and double confirm here that you've taken something away from this in terms of how to protect yourself around these volatile markets, around how to adjust your risk management during these times. Once the market settles down again, you're going to reject. You can use these same techniques to adjust to reduce your stop losses, to maximize your risk that way, to manage your risk that way. Okay, so it's just by using these principles, you just adjust your risk throughout the markets as they change. Okay, so hopefully you've that's all been clear and helpful. Okay, so we are coming to the end of the session now. As mentioned, please do stay on for a short survey just to answer any questions answer some questions which will allow us to tailor these webinars going forward to make sure that they are of most value and use to you as well and provide the right education that you guys are after as well. So, yeah, any final questions for me, please do fire away. Other than that, I look forward to speaking to you at our next webinar, which will be, I believe, will be focused on US equities as well and how to trade US equities. Emil, thank you very much. I'm glad you enjoyed it. Dell as well. Thank you very much. You can if you would like to register for that webinar, the next webinar, and you can see the link provided in the chat box as well from the team. Asif, thank you very much as well. Yeah, if you please do register for that webinar, you'll get the updates, you'll get the notifications to tell you when it's happening. You can add it to your calendar, make sure you don't miss it, and again, hopefully provide some really good content for you then as well. Perfect. Thank you very much, Christopher. Cool. All right, guys. With that said, then no other questions coming through apart from Farik. If you could please, admin, if you could please send the email address to Farik for him to send in around the VWAP. I will be more than happy to do that. So yep, please do fill out that survey so we can get your feedback. Have a great time trading. Stay safe in these markets, and we will speak to you again soon. Cheers, everyone.